Recently, with a God's bullet passing through Trump's ear and Biden being reported to have contracted COVID-19, the election situation seems increasingly one-sided. It seems like it's only a matter of time before Trump becomes the 47th president of the United States. This has triggered the so-called Trump trade in the capital markets, where investors adjust their investment strategies based on the policies Trump might implement. Let's break down the market consensus on the Trump trade and Trump's anti-consensus, which are his statements or actions that differ from market expectations. Firstly, Trump's policies of tax cuts, increased tariffs, and immigration restrictions might lead to higher prices because these measures could increase demand for goods and services while also raising production costs. In response, Trump stated he cannot accept inflation and has even mentioned in the Republican Party platform the need to end inflation.
So tonight, I make this pledge to the great people of America. I will end the devastating inflation crisis immediately, bring down interest rates, and lower the cost of energy. We will drill, baby, drill.
Secondly, if inflation rises, then the long-term interest rates on government bonds might remain at higher levels. Trump has expressed his desire to keep interest rates low, with low interest rates being a key term in Trump economics. Additionally, Trump's trade protection policies and fiscal stimulus might strengthen the dollar. Trade protection would reduce imports, increase exports, and thus decrease the trade deficit, while rising risk aversion could increase demand for the dollar. However, Trump wants the dollar to weaken to boost exports and reduce the trade deficit. This seems contradictory to his other policies, such as trade protectionism, which could actually strengthen the dollar. Exchange rates are influenced by many factors, with monetary policy and economic performance playing decisive roles. Furthermore, Trump's large-scale tax cuts and deregulation policies are beneficial for the stock market because these measures could stimulate economic growth and increase corporate profits. In reality, though, during the 3 trading days when Trump's election chances surged, the S&P 500 fell by 0.48%, and the Nasdaq dropped by 2.19%. The reasons for the stock market decline could include the early fulfillment of interest rate cut expectations, a shift in market risk preferences, adjustments in the semiconductor supply chain, and the release of risks from tech giants. It is widely believed that Trump will become the 47th president of the United States, which could further promote the Trump trade. In reality, despite Trump's high probability of winning, there is still a long time before the final election. During this period, various changes could occur and the Democrats will not give up easily, so it is still uncertain who will ultimately win. In future observations, it is essential to distinguish between Trump's policies and slogans, paying attention to the implementation strength and pace of specific policies. Additionally, investors should be aware of risks related to inflation and geopolitics. In simple terms, do not just listen to what Trump says, pay more attention to what he does and how these actions affect the economy and the market.